All right, today we're tackling a scenario where the market is right on the brink of a full-blown crisis. I mean, what happens when the politics of money, the actual plumbing of the financial system, and the very idea of trust all start to crumble at the same time? Let's dive in. Okay, so picture this. It's late January 2026, and all the warning signals are flashing bright red across every asset class. This isn't just your normal, everyday volatility. No, we're talking about outright panic, total confusion, and a desperate, frantic search for any safe place to hide. And get this, for the first time ever, gold has absolutely smashed through the $5,000 an ounce mark. This isn't just a rally, you guys. It's a full-on stampede into the oldest, most trusted safe haven on the planet. And at the exact same time, silver has gone completely parabolic. We're talking an incredible 272% gain year over year. It's a mix of real industrial demand and just pure speculative fever. People are calling it gold on steroids, and honestly, you can see why. But here's the flip side. While all that old money is thriving, the new money is getting absolutely crushed. Bitcoin has just tumbled below $84,000. It completely failed its big test as a digital safe haven, and it's just wiping out legions of traders in the process. Look, these aren't just random, chaotic market moves. They're symptoms. Symptoms of three massive structural fault lines cracking wide open right under the global financial system. So what we're going to do is trace each one, and we're starting with a political earthquake that's shaking the U.S. Federal Reserve to its very core. So yeah, our first fault line, it runs right through Washington, D.C. There's been a huge change in leadership at the world's most powerful central bank, and it's sending massive shockwaves through the entire system. So after months and months of speculation, President Trump has picked his guy. Former Fed Governor Kevin Warsh is in, replacing Jerome Powell. Now, Trump apparently praised Warsh for looking the part, calling him central casting. And it seems he got the job over other candidates partly because of his really deep social network with Trump's long-term donors. Okay, but here's where this gets really interesting. Analysts are calling it the Warsh Paradox. And the reason is the market is completely baffled. You see, Warsh built his entire reputation on being this famous inflation hawk. The guy who's always worried about inflation and wants higher interest rates. But now, he's suddenly sounding like the complete opposite, a total dove. And this comparison just leaves the contradiction bare. I mean, on one hand, you have the historical Warsh. This guy was so worried about inflation, he was against stimulus, even during the 2008 crisis. But the new, contemporary Warsh, he's arguing that things like AI have made the economy so productive that the Fed can slash rates without causing inflation. He's even gone on record criticizing the previous Fed for not cutting rates sooner. And let me tell you, the market is not buying this sudden change of heart. Not for a second. As one Morningstar analyst put it so perfectly, everyone sees this as just easy money dressed up in hawkish vocabulary. In other words, it's a political move, plain and simple. Give the president the low rates he wants, but try to sound tough while you're doing it. And the market's reaction? It was immediate, and it was brutal. We're seeing this massive loss of faith in the Fed's independence. Investors are now demanding much, much higher interest rates on long-term government debt because they're convinced inflation is coming. There's a name for this. It's called a bear steepening, and it's a flashing red sign that the market thinks Warsh is going to sacrifice long-term stability for short-term political wins. And there it is, our first fault line. A central bank that's been captured by politics. All right, let's move on to our second fault line. This one is less about politics and psychology and more about, plumbing. We're going from the high-level theory down into the pipes and gears of the financial system because they are starting to break down. To put it really simply, the whole system is just running out of cash. Just take a look at this chart. The Fed's Overnight Reverse Repo facility. People call it the ONRRP. You can think of it as a giant cash shock absorber for the banking system. At its peak, it held over $2.5 trillion. Well, as of January 2026, it's basically empty. The last big safety buffer, it's gone. So why is that such a big deal? Well, because without that cushion, the Treasury's massive borrowing is acting like a giant vacuum cleaner. It's having this direct sucking effect on all the cash in the banking system. Every single time the government issues new bonds, it's literally pulling cash right out of bank reserves, and that leaves less and less money to keep the markets running day to day. Now, you might be thinking, hey, haven't we seen a cash crunch like this before? And you'd be right, back in 2019. But this time is different. It is way more dangerous. The cause is bigger, that cash buffer we talked about is gone, and this is the really scary part, we have no idea what the Fed is going to do. Back in 2019, they just started printing money, QE, but today's nominee, Warsh, he's famous for wanting the opposite, QT, which would pull even more money out of the system. I mean, it is a recipe for absolute disaster. So let's recap. You've got a Fed that's been politicized and a financial system that is literally running out of cash. So what happens next? Well, that's our third fault line. It's the logical result, a full-blown crisis of confidence in money itself, and this frantic scramble to find any asset that you can actually trust. And that brings us right back to where we started, with this number. Gold soaring past $5,000 an ounce. It is the clearest signal you could ask for of this crisis. It tells you that the big money, we're talking everyone from central banks down to individual investors, they are losing faith in currencies that are backed by nothing more than a government's promise. And there are some deep, fundamental reasons for this surge. For one, central banks all over the world are actively trying to own fewer dollars. Then there's this growing fear that the U.S. simply has no choice but to inflate away its mountain of debt. Plus, geopolitical tensions are just boiling over everywhere. And this isn't just numbers on a screen. We're talking about physical gold bars being loaded up and shipped from vaults in the West to new owners in the East. But while all that capital is flooding into gold, it's stampeding out of crypto. In a single 24-hour period, almost $500 million in leveraged crypto trades were forcibly shut down. It was a complete and utter bloodbath. So why is Bitcoin imploding? It really comes down to three things. First, you had a classic liquidation cascade. All the traders who borrowed too much got totally wiped out. Second, the big institutional money is sprinting for the exits. We saw a record amount of cash pulled from Bitcoin ETFs. And third, and this is the big one, when the chips were really and truly down, investors chose the 5,000-year-old safe haven over the 15-year-old one. That whole idea that crypto was a refuge in a crisis, yeah, that's been shattered. But out of all this chaos, something pretty remarkable is actually happening. The two big U.S. financial regulators, the SEC and the CFTC, have just announced Project Crypto. It's this landmark joint effort, basically born out of the crisis, to finally create a clear, unified rulebook for digital assets. The crash, ironically, gave them the political cover they needed to act. So yeah, it's causing a ton of short-term pain, but this could actually be the foundation for crypto's long-term survival. Okay, so let's put all the pieces together. We have a politicized Fed, a financial system starving for cash, and a massive crisis of confidence. The big question is, where does all this lead? Well, the report we've been breaking down lays out three possible futures. The most likely scenario, with a 45% probability, is what's called a stagflationary shock. That's the worst of both worlds, high inflation and low growth, a truly toxic mix for pretty much every asset. The second most likely path, at 35%, is a deflationary crash. That's where the whole system just seizes up, and the dollar actually soars as everyone panics to get their hands on any cash they can. And that optimistic, soft landing we all hope for, that's a distant third, with only a 20% chance. And that really leaves us with one final, crucial question to think about. All three of these fault lines, the politics, the plumbing, and the crisis of trust, they all point to a new reality. A world where financial markets aren't just reflecting the economy anymore. They've become an extension of the political battlefield. And in that kind of world, the biggest challenge for all of us is trying to figure out, how do you find safe ground?